Ladies and gentlemen, Asian guy here. And before you close this tab because you're still traumatized from yesterday's bloodbath, I need you to hear something that's going to completely change how you see what just happened. Yesterday wasn't the end. Yesterday was the setup. I know exactly what you went through. You watched silver climb to $83.62, an all-time high that made you feel like a genius for holding through the doubters. Then, in what felt like seconds, the entire move evaporated. $83 became $80, then $77. Then suddenly, you're staring at $73 and wondering if you should just sell everything and forget precious metals ever existed. The financial media is already writing the obituaries. Silver bubble pops. Retail investors flee volatility. The bears are doing victory laps, claiming they warned you this would happen. But here's what none of them are telling you, and what I'm about to prove with hard data. The crash stopped at exactly $75.32 for a very specific reason. And that reason has nothing to do with panic and everything to do with mathematics. While you were watching your screen in horror yesterday, three things happened simultaneously that nobody's connecting. First, the price bottomed at $75.32, within 52 cents of the 23.6% Fibonacci retracement level calculated from the entire November rally. And second, COMEX registered inventories now sit at 449,127,595 ounces, the lowest since March 2020, after 600,133 ounces were physically withdrawn Friday. Third, the RSI bounced at 65, not 30. That's not a reset. That's a market that refuses to cool down even during a crash. When you understand what these three data points mean together, you'll realize that yesterday's sell-off wasn't the smart money exiting. It was the smart money finally getting the dip they've been praying for since we broke $75 3 weeks ago. Let me show you something on the chart that's going to blow your mind. Pull up your daily silver chart right now. I want you to draw a Fibonacci retracement from the absolute low of this rally, back on November 8th, when we were grinding at $62, all the way up to yesterday's high of $83.62. When you draw that line, your charting software automatically calculates several key retracement levels. These are the mathematically predictable points where corrections tend to stop during healthy bull markets. The shallowest level, the first line of defense, is the 23.6% retracement. You know what that level calculates to? $74.80. Now look at yesterday's low, $75.32. We came within 52 cents of touching that line and bounced violently. The algorithms that control 70% of market volume hit their buy triggers within $0.50 of the mathematical target. This is not a coincidence. This is not luck. This is the signature of institutional accumulation programs executing exactly as designed. Let me explain why this matters so much. In technical analysis, there's a massive difference between a shallow retracement and a deep one. When a bull market corrects to the 23.6% level and holds, it's screaming strength. It's telling you that buyers are so aggressive, so desperate to get in, that they won't even let the price correct to the normal 38.2% or 50% levels. Think about it from the perspective of a fund manager who missed the rally. You watched silver go from $62 to $83 in 6 weeks. You kicked yourself for not buying at $65, then at $70, then at $75. By the time it hit $83, your risk management model said don't chase, but now it's crashing. Your model says the fair retracement to the 38.2% level would be around $71. The 50% retracement would be $67. Do you wait for those levels? No, because you know every other fund manager on Wall Street is running the same calculation. You know that if you wait for the perfect entry at $67, you might get zero execution. The buying pressure will be so intense at those deeper levels that the price never gets there. So what do? You front run the retracement. You put your buy orders at $75, right above the 23.6% line, accepting a slightly worse price in exchange for guaranteed execution. And that's exactly what we saw yesterday. The price touched $75.32, found a wall of institutional buy orders, and reversed 8% in hours. This is called a V-shaped recovery from shallow retracement, and it's one of the most bullish patterns in technical analysis. But the Fibonacci level is just one piece of the puzzle. Let me show you the second mathematical line that confirms this floor. Right now, the 20-day moving average for silver sits at $73.50. This line represents the average price that silver has traded at over the last month. In a normal, healthy correction, price typically revisits this line. It's called mean reversion, the market's way of resetting after getting too hot. But look at what happened yesterday. We bottomed at $75.32, nearly $2 above the 20-day moving average. We didn't even touch it. This is what professional traders call floating above the mean, and it only happens in the strongest trending markets. It means buyers are so confident that they won't even wait for the statistical average price. They're willing to pay a premium above fair value just to secure inventory. Compare this to what happens in a dying trend. When a bull market is actually ending, price crashes through moving averages like they don't exist. The 20-day gets violated, then the 50-day, then the 200-day. It's carnage. But yesterday, we respected the 20-day without even testing it. We found support, $2 above where statistical models said we should find support. That's not weakness, that's power. And here's why this is happening. Industrial buyers, think about the procurement manager at a solar panel manufacturer. For the last 3 weeks, silver has been trading at $78 to $83. Every day that passes, his inventory gets lower. Every day, he's more desperate to restock. But at $83, the metal is too expensive relative to his forward contracts. Then yesterday happens. Silver crashes to $75. For this industrial buyer, that's not a crisis. That's Christmas morning. He immediately calls his broker and says, "Fill me at anything below $76. He doesn't care about the 20-day moving average. He doesn't care about RSI. He cares about securing physical inventory before the January 1st export restrictions make Chinese silver essentially unavailable. This industrial bid acts like a hydraulic floor under the market. And it's sitting right here at $75, which brings us to the third and most important confirmation signal. Technical indicators can be faked. Price action can be manipulated. But volume? Volume is truth. Look at the volume bars at the bottom of your chart during yesterday's crash. You'll see high volume as the price was falling. That's the panic sellers, the overleveraged margin calls, the retail traders giving up. But watch what happens as we approach $75.32. The selling volume starts to dry up. The bars get shorter. This is called volume exhaustion, and it's the technical signature of a market that has run out of sellers. When you run out of sellers, guess what happens next? Even the tiniest bit of buying pressure sends the price screaming higher, and that's exactly what we saw. As the price stabilized at $75, the volume on the buy side started increasing. Green bars getting taller. This is institutional accumulation. This is the smart money loading the boat while retail is still crying about losses. The volume profile for the entire November-December rally shows a massive cluster of trading activity right in the $75 zone. Back in late November, we spent over a week churning between $74 to $76 with millions of contracts changing hands. Why does that matter now? Because every trader who bought at $75 in November is now defending that level like their life depends on it. When the price came back to $75 yesterday, they weren't scared. They were at break even. And the traders who sold at $75 in November, betting against the rally, have been suffering ever since. Yesterday gave them a chance to cover their shorts without catastrophic losses. So you had two massive forces buying at $75, bulls defending their entry, and bears covering their mistakes. This creates what's called a volume node, a price level where so much trading activity has occurred that it acts like a sponge, absorbing selling pressure without the price moving. You could throw $1 billion of sell orders at $75 right now and the sponge would soak it up without breaking. Now look at the shape of yesterday's daily candle. Open your chart on the daily time frame, not the 1 hour noise, not the 5-minute panic, the daily view. You're looking at a textbook hammer formation. For those unfamiliar with candlestick patterns, a hammer has a long lower shadow, the handle, a small body, and little to no upper shadow. It looks like, well, a hammer. This pattern forms when sellers push the price down aggressively during the session, but buyers step in and drive it all the way back up by the close. The long lower shadow represents the rejected lows. Price went down there, looked around, found zero interest in staying there, and reversed. When a hammer forms at a key support level like the 23.6% Fibonacci line, it's one of the highest probability reversal signals in technical analysis. It's the market's way of saying, we tested lower prices, we rejected them, we're going back up. But the hammer isn't the only signal confirming this reversal. We need to look at momentum. During yesterday's crash, bearish traders were celebrating that silver was finally cooling off. They pointed to the RSI, Relative Strength Index, and claimed it needed to reset from overbought levels. Well, let's look at what actually happened to the RSI. Did it crash to 30, entering oversold territory? Did it reset to 40, giving us a deep momentum cool down? No, it bounced at 65. The RSI is currently sitting at 65, a level that's technically still considered elevated. In a normal market, corrections take the RSI down to at least 40 before reversing, but we never got close. This is what's called a bull market RSI range. In super strong trends, the RSI doesn't oscillate between 30 and 70 like textbooks say. It oscillates between 60 and 90. The fact that we bounced at 65 means the momentum floor has shifted up. We're not cooling down. We're refusing to cool down even during a crash. This is the behavior of an asset that wants to go higher, not lower. While everyone was panicking about the price action, something critical happened in the physical market that almost nobody noticed. According to the latest COMEX warehouse report, registered silver inventories now stand at 449,127,595 ounces. That's down from over 500 million ounces earlier this year, a loss of more than 50 million ounces in just a few months. But here's the kicker. On Friday, December 27th, right before the crash, 600,133 ounces were physically withdrawn from COMEX vaults. Let that sink in. Somebody took delivery of $50 million worth of physical silver at $83 per ounce right before the crash and removed it from the exchange. This wasn't a retail investor. This wasn't panic buying. This was a sophisticated entity that looked at the price, looked at the inventory situation, and said, I need to convert my paper claims to physical metal right now, regardless of cost. This is the behavior of someone who knows the paper price is fake. They're using the high prices to drain physical supply while they still can, because they understand that once the January 1st export restrictions hit, getting physical silver is going to become exponentially harder. The ratio of paper claims to physical metal on the COMEX is now over 2-to-1. For every ounce of actual silver in the registered category, there are over 2 ounces worth of contracts claiming ownership. This is a powder keg. And yesterday's crash just removed one of the major sellers, the overleveraged hedge fund that got liquidated, without reducing the structural supply deficit at all. So let's connect all these dots. We have a mathematically perfect bottom. At the 23.6% Fibonacci level, we have a 20-day moving average that held without being tested. We have volume exhaustion at the lows and accumulation on the bounce. We have a hammer candle rejecting lower prices. We have an RSI that refuses to reset. And we have COMEX inventories at crisis levels while physical withdrawals accelerate. Every single technical and fundamental indicator is screaming the same thing. Yesterday's crash was a liquidation event, not a trend change. The weak hands are gone. The overleveraged speculators have been flushed out. The market structure is now cleaner than it's been in months. And here's what almost nobody is considering. The crash happened before the January 1st catalyst. Think about the timing. We're 48 hours away from Chinese export restrictions taking effect. The market just experienced a violent shakeout that removed the weak holders. And now we're sitting at a technical fortress of support with institutional buyers aggressively accumulating. What happens on January 2nd when those export restrictions are confirmed and industrial buyers realize they're running out of time? Now, I'm not going to sugarcoat this. We're not completely out of the woods yet. There are specific risks over the next 24 to 48 hours that could test this $75 floor one more time. The biggest immediate threat is the Federal Reserve. If the FOMC minutes or any Fed speakers this week signal hawkish policy, higher rates for longer, concerns about persistent inflation, it could send the dollar screaming higher. And when the dollar spikes, silver typically drops. It's a mechanical correlation that algorithms execute automatically. We're also watching the DXY dollar index, which is currently hovering near 109. If it breaks above 110, that's a wrecking ball for commodities. The pressure on silver could become intense. And finally, there's the China policy wildcard. We're all assuming the January 1st export restrictions will be strict. But what if the details come out softer than expected? What if China issues more export quotas than the market is pricing in? That would be a deflationary shock for silver prices. The Shanghai premium would collapse, not by New York rising, but by Shanghai falling. I don't think this will happen. The geopolitical incentives point toward China weaponizing resources, not sharing them, but as a risk manager, you have to acknowledge the possibility. If we survive the Fed noise and the dollar stays below 110, here's the path I'm watching. First resistance, $78 to $79. This is where the crash began on Friday. Breaking back above this level confirms the liquidation is over. Second target, $82 to $83. This represents a full retest of the previous high. If we reclaim this level, the narrative flips completely from bubble popped to dip bought. Major breakout, $85 to $87. This is where we enter true price discovery above the old all-time highs. This is where FOMO kicks in and momentum traders pile back in. Measured move target, $92 to $95. Based on the size of the consolidation we just completed at $75, the measured move points to this range as the next logical stopping point. But here's what's important to understand. The recovery doesn't have to be immediate. We might chop around $75 to $78 for a few days while the market digests the Fed risk and the China news, That's normal. That's healthy. The floor is built. The weak hands are gone. The industrial buyers are defending this level. As long as $75 holds, the bull market structure is intact. Let me leave you with one critical concept that will save you from making emotional decisions. A correction is when price pulls back to a logical support level, finds buyers, and reverses. That's what we just saw. A crash is when price breaks through support levels like they don't exist, takes out the moving averages, destroys the momentum indicators, and doesn't stop until it finds a new equilibrium far below where it started. Yesterday looked like a crash. It felt like a crash. But when you examine the technical damage, it was actually a violent correction that held exactly where it should have held. We didn't break the 20-day moving average. We didn't take out the volume node at $75. We didn't crash the RSI into oversold territory. We didn't trigger a structural breakdown. We hit a mathematically predictable support level, formed a hammer candle, saw institutional accumulation, and bounced. That's not a crash. That's a shakeout, followed by a refueling stop. The difference between traders who make money and traders who lose money isn't intelligence. It's emotional control. It's the ability to look at a day like yesterday and see opportunity instead of disaster. The weak hands sold at $75 yesterday because they were scared. The strong hands bought at $75 because they understood the setup. The question is, which one are you going to be when we're back at $90 in 6 weeks? Because yesterday didn't end the silver bull market. Yesterday created the setup for the next explosive leg higher. The floor is $75. The inventories are at 449 million ounces and dropping. The export restrictions take effect in 48 hours. The technical pattern is perfect. And while everyone else is still traumatized from yesterday's bloodbath, the smart money is loading up for the move nobody sees coming yet. Asian guy here, and I'll see you at $90.